How you doing? I'm Big D. Welcome to the show. What I got to talk about is silver. What's going on with silver, silver prices, and hopefully you won't be shocked. I'm already shocked. Let's start off with Friday afternoon. This past Friday, the closing bell, the screens flashed red, silver plummeted about 4%, like that, in a heartbeat. The headlines immediately flooded. Silver bubble pops, speculation flee, rarely overheats. Natural correction after parabolic move, and it was almost $65 on Friday morning. That is the consensus view. That's in a narrative designed to keep you calm. It tells you that markets are efficient. It tells you the price is simply a reflection of the buyers and sellers reaching an agreement. They want you to believe that Friday was a standard market fluctuation. They want you to believe that gravity simply took over. But if you look at the timestamps and if you look at the clearinghouse advisories, you realize that gravity had nothing to do with this. That wasn't a sale. That was an eviction at exactly the close of business on Friday. That was December 12th, 2025. The CME group did not just watch the market. They reached it into the machine and changed the physics of the trade. They issued a clearing advisory, a document that most retail investors will never read. But it is the only document that matters. They realized the initial margin requirements for a $5,000 silver contract went from $20,000 to $22,000. A 10% increase in the cost of entry instantly, overnight, effective immediately. The mainstream media calls this a cooling measure. I call it $22,000 kill switch. Welcome to Capital Cycle. We do not read the news. We extract the mathematical truth. And the truth is that the global silver market is no longer operating under standard equilibrium conditions. We have officially transitioned from mode B, accumulation, into mode C, which the shift, what we witnessed on Friday, was not a market correction. It was a kinetic regulatory intervention designed to arrest a volatile event, so to speak, that was threatening the integrity of the clearinghouse. Let's strip away the noise. Let's look at the forensic evidence of what actually happened at $64.56. Because the math tells a very different story that the price chart does. When you look at a red candle on a chart, you assume settlement changed. You assume people woke up and decided silver was worth less. That is false. Friday's crash was function of sovereignty, not settlement. Future markets run on a credit. They run on leverage. Leverage is a privilege. And on Friday, the exchange decided to revoke that privilege. Here's a mechanism of the crash. Thousands of speculators were holding long positions as silver hit an all-time high. They were leveraged. They were confident. Then the notification hit the clearing firms. The cost to hold those positions just went up by $2,000 per contract. Now, $2,000 might not sound like much to a bank, but apply that multiplier to the open interest. There was over 165,000 contracts opened on the COMEX. When you raise the capital requirement by $2,000 across the volume, you are effectively extracting nearly $200 million of liquidity from the market in a single instant. The traders holding those contracts faced a binary choice. Option A, wire millions in fresh capital immediately to meet the new maintenance margin. Most retail traders, do not have millions in liquid cash sitting around. Most mid-sized hedge funds do not have that capital allocated. So they are forced into option B, liquidation. They have to sell, not because they want to, but because the algorithm forces them that they need to sell at the market that they hit the bid. This creates a cascading effect. As they sell, the price drops. As the price drops, the equity and other accounts falls within, which also triggers more margin calls, which triggers more selling. It is a feedback loop of forced insolvent. The drop to $61.36 was a mathematical result of this loop. It was an engineered flush. But here's where the forensic detective must ask the most important question. Why now? Why did they put the lever at, say, almost $65? The exchange will tell you they are protecting market stability. They didn't want it to shoot where they know it would have probably have gone to about 70, in my opinion. I am not a financial guy. I'm not telling you to go buy silver. None of that stuff. I'm just giving you some details so hopefully you have an idea what's going on. They use a system called SPAN, Standard Portfolio Analysis of Risk. It scans volatility. When the price moves too fast, the computer predicts a higher probability of a tail risk event. So it demands more collateral. It is automated. It is cold. It is precise. But history tells us something else. Markets do not raise margins on assets that are irrelevant. Markets do not raise margins on assets that are dormant. They do not raise margins on assets that nobody cares about. They raise margins on assets where the price velocity threatens the breaking the system. They raise margins when they are afraid. They saw this in 1980. Well, we all saw this in 1980 when the Hunt brothers cornered the market. The exchange raised margins repeatedly until it was literally impossible to buy. We saw this in February 2021 during the silver squeeze. The exchange raised margins by 18% and the price dropped $2 the same day. We are seeing the exact same playbook executed in 2025. This is interventions paradoxically confirms our bullish thesis. If silver was truly abundant, if there was plenty of physical metal to meet demand, the price would self-correct. Suppliers would sell, inventory would flood the market, and the price would stabilize naturally. But that is not happening. The physical market is broken. We are in the 5th consecutive year of structural deficit. The world is missing 800 million ounces of silver since 2021. The warehouse in London is being drained. The registered stock on the COMEX are depleted. The free float of available silver is collapsing. So the paper market has only one tool left. Force the price down, kill the momentum, scare the tourists. This is a capital war between the paper derivative market, which is trying to de-risk, and the physical supply chain, which is screaming for inventory. The exchange effectively signaled that volatility above $65 is currently systematically unacceptable. They have placed a ceiling made of regulatory friction. But they are, excuse me again, but they are fighting against the irresistible force. Solar panels, electric vehicles, AI data. These industries are, and buyers are pushing huge prices because of the demand of silver. A solar panel manufacturer does not care about the margin requirement on the COMEX. They need physical silver to conduct electricity. They cannot print silver. They cannot digitally create silver. They have to buy it. And if the price is $60, they pay it. If the price is $100, they pay it. Because without it, their product does not work. There is no other market, no other metal on this earth that can take the place of silver. Now, the paper price is being managed by margin hikes, but the physical demand is driven by the industry or industrial necessity. This creates a coil spring. The margin hike to $22,000 is not the end of the bull market. It is a confirmation that the bull market has become dangerous to the status quo. The paper authorities have fired their shot. They have played their card. They have raised the wall. Now we wait to see if the physical reality yields. Geologically suggest it will not. History suggests it will not. The deficit is real, the shortage is structural, and the intervention we just witnessed is the clearest signal yet that the smart money is terrified of losing control. This is not a time of panic. This is time to understand the battlefield. You are not watching a crash. You are watching a stress test of the market structure during a phase change. The exchange is trying to cool a reactor, but the fuel rods are still burning and the temperature is rising. But there is deeper mystery here, something that does not show up in daily charts, something that is hidden in the millisecond between the trades while everyone is focused on the $22,000 margin. They are missing the second weapon that was deployed on Friday. The invisible wall. Most traders believe that if buying pressure is strong enough, the price can go anywhere. They believe in the free market. They believe that if a million people want to buy silver at $70, the price will go to $70 immediately. That is a lie. The price is not allowed to go to $70 immediately because of the mechanism known as a Rule 589. This is the code name for the special price fluctuation limits. And if you don't understand this rule, you are bringing a knife to a nuclear war. Unlike the old days where there was a simple daily limit, say $30, and then the market closes, the modern system is dynamic and it's alive. It watches the price every single second. It uses a rolling 60-minute look-back window. Think about that. The exchange is constantly calculating a move ceiling above the price. And if you hit that ceiling, the gain stops. For silver, the first trigger is $3. If the price moves $3 from the reference point, the market enters a level on halt. 2 minutes of silence, no trading, frozen. If it moves $6, level 2, 5 minutes of silence. And if it moves $12, level 3, the duration is undefined. You can shut it down for the rest of the season. They can shut it down until the next day. They have total discretionary control. Why does this matter? Because on Friday, we didn't see a margin hike. We saw an impact of the steel ceiling. When an algorithm detects that a limit is approaching, it does not apply. It just buys. It pulls liquidity. The high-frequency trading bots are programmed to flee. They vanish. So as the price surges towards $66, The order book thinned out. The buyers disappeared, not because they didn't want the silver, but because they were terrified of getting trapped in a halt. This is how you kill momentum. Without selling a single ounce of physical metal, you create a structure where speed is punished. You create a structure where going vertical is mathematically impossible. This is the steel ceiling. It guarantees that the ascent of silver will not be a straight line. It will be stepped, ascent, violent bursts followed by forced cooling periods followed by margin hikes. This is designed to exhaust you. It is designed to make you sell out of your frustration. It is designed to make you believe that rally is broken, but it is not broken. It is being throttled, and there is a massive difference between a broken engine and a throttled engine. Most investors will see the red candle and walk away. They will go back to the S&P 500. They will go back to their 6% returns and their 401ks. They will miss the greatest wealth transfer in history because they do not understand the plumbing of the exchange. This is why we exist, to read the rule book that they use against us. If you want to be a part of the 1% who prepares, if you want to understand the difference between price and value, make sure you are subscribed. Turn on the notification, hit that bell, because the next signal might be the last one you get before the window closes. Thank you for stopping in. God bless. Have a great rest of your day.